Good morning, everyone, from slightly chilly London today. Welcome to the oil webinar in our Commodities Outlook 2020 series from Refinitiv, where you will hear from a number of our experts and analysts across different asset classes. We will give everyone 1 or 2 minutes to ensure that everyone is dialed in, and then we will properly kick off the webinar after 50 to 60 odd seconds. So I'll go on hold. There will be a quiet time on the phone lines while we give everyone a chance to dial in, and then we'll properly kick it off. Thank you. Right, this is 2 minutes past 10 in London. Again, all of you who have joined us on this webinar today, we will be taking a deeper dive into the oil markets and oil domains with our experts and analysts who are available to go through a number of different markets. As I mentioned, we will have this as a webinar series. You will hear from different experts, different asset classes. And if you haven't already signed up, please do reach out and speak to us so that you can have access to all the other webinars as well. Today, I'm obviously delighted to have 2 of our esteemed experts joining us. Today, we will hear from Ehsan Ul-Haq, who is the lead analyst for our oil team, as well as Alex Pearce, who is the lead analyst on the refined product side, who will go through a number of different market updates, forecasts, and discussions, obviously, that we will have at the end of the webinar, where we will open up for Q&A for all of you. A few housekeeping bits. If you are already listening to me, that means you are dialed in via your PC, but this is a listen-only webinar. So you will need to switch on your laptop, your desktop, or anywhere you are listening in from to ensure that the voice is coming through nice and properly across to you. If you have any questions, we will dedicate some time for Q&A at the end of the webinar. But if you do want to send across your question, you will see a little Q&A tab or a little icon at the bottom of your screen that you can put in your question, type in whatever you want to, and we will try and answer it at the end of the webinar as well. There are a few resources available. You can engage with the different resources and the research bits available. You also have links to our social media profiles and all the other bits that are available within that domain. Many of you might be aware of us anyway, but Refinitiv, obviously, we were formerly known as the financial and risk business of Thomson Reuters. Since October, about 2 years ago, we are known as Refinitiv, and we provide expertise in data, analytics, trading platforms, and technologies across the whole workflow and the life cycle of commodities, as well as so many other asset classes that we cover within our domain as well. So with that, I'll hand it over to our proper speakers today, Ehsan and Alex, who will take you through to the rest of the webinar.
Good morning. First of all, I will go through agenda. Before going through the agenda, I wanted to point out a few things. One thing is that we will not be talking about the impact of the coronavirus on demand. We will not talking about the peak demand or peak supply. We will be talking about key trends in the European market based on data we deliver and what we can find out based on that data. So starting with crude, we have found four key trends in the European crude market. The medium sour market is facing challenges as there is less and less demand for medium sour crudes in Europe because of the IMO 2020 the bunker specification change. We are also seeing a big shift in light sweet crude sources. As North Sea production declines, more and more U.S. production is coming to Europe. There's little change in heavy sweet supply in spite of big emphasis on heavy sweet in 2019. In the North Sea market, we are seeing also shifting changes as far as demand, especially in Asia, is concerned, moving towards China from South Korea. And as far as the refined product market is concerned, Alex will show us the agenda for today's webinar.
Hi everyone, so I'll be talking a little bit more about the sort of trends we're seeing in refined products, particularly on the IMO specification changes. So the focus for my part of the presentation will be looking at the pricing spreads for VLSFO and how they differed in Northwest Europe and Asia, how Europe has really positioned itself as a price leader for VLSFO and some of the factors that have been impacting that. And then lastly, how high sulfur fuel or HSFO strength has really sort of surprised the market, and also how diesel and distillates really have also been pretty weak, contrary to sort of beliefs before IMO. So I'll go into a little bit more detail on the refined product side after Ehsan's presentation. So I'll just hand you back to him now.
So starting with the European crude slate, what we have seen in 2019, also continuing in 2020, that light-heavy ratio has not changed significantly in Europe, in spite of emphasis on heavy sweet crudes in 2019. I mean, light crude has been most of refiners in Europe, they prefer lighter crudes. I mean, on the whole, there's no big change. There was a big shift at the end of 2017. Most of our data is based on seaborne crude flows, although we have included some data from our affiliate in Russia, Cortis, which collects data about the Druzhba pipeline. So based on this information, there was a big a jump in lighter crudes at the end of 2017 because of Forties having problem. Otherwise, we are seeing similar pattern. So I mean, lighter crudes are preferred by European refiners, but the light-heavy ratio has remained almost unchanged in a couple of years. On the other hand, we have seen refiners buying more sweet than sour in order to minimize fuel oil production, and also because of lower sour crude availabilities because of OPEC plus cuts. So moving to the next slide, as far as the medium sour market is concerned, OPEC has reduced its supplies intentionally or unintentionally by around 4 million barrels per day since 2017. Since 2017, OPEC has reduced supplies by around 4 million barrels per day. However, it has lost around 5 million barrels per day of medium sour supply. This is a big change. As a result, it has impacted supply. On the other hand, we have seen Iran losing its exports, also less and less crude coming from Venezuela. So as a result, what we have seen is, in spite of these things, we are seeing medium sour, the percentage of medium sour in European crude supply declining. At one point, it used to be more than 40% in 2017. Now it's slightly above 20%. So more sour crude being replaced by lighter crude. But as far as medium sour prices are concerned, they have not been impacted too much by lower demand for medium sour grades because of OPEC plus cuts. So what we also see, there are two key players in the European medium sour market. One is Russia, and then we have Iraq. And because of the contamination of Russian crude at the end of April, May last year, what we saw is that Iraqi crude supplies to Europe, they jumped. So, but I think otherwise, Russia remains the key supplier of medium sour crude in Europe. As far as light sweet supplies are concerned, I mean supplies from Kazakhstan, the UK, and the US rose in 2019 compared to 2018, but the most important one is the US. I don't think that anything will change regarding Kazakhstan or the UK. So what is happening is that as North Sea production declines, more and more crude is coming to the US. And what is also happening is that if China, for example, boosts its crude imports from the US in line with the phase 1 of the trade agreement, what would happen? It would mean that WTI prices will increase. If they increase, the spread will narrow, and I think this arbitrage from the US crude arbitrage to Europe is still dependent on the arbitrage economics. As a result, if China buys more, it might have impact on flows to Europe. But on the whole, what is happening is that there are two countries, we have to point out, there are two key countries which are importing a lot of US crude. One is the UK, the other is Netherlands. What they do, they bring US light sweet crude, process it into gasoline, and then send this supply across the Atlantic to the East Coast. Because of the Jones Act, it's difficult to get too much gasoline supply from the US Gulf Coast. As a result, Europe has become a key supplier of gasoline to the East Coast. So as far as other key trends are concerned, in spite of so much emphasis on very low sulfur fuel oil and MGO, I mean, as far as distillate rich crude supply from West Africa is concerned, it was down compared to 2018. So there's not too much interest in distillate rich supply. Same was the case. I mean, if we take the average for crudes which are rich in distillates and compare them with crudes which are rich in light distillates, naphtha-rich crudes. So what we see is, as far as light distillate-rich supply is concerned, it's almost stable. But middle distillate-rich supply is going down. It's the same with if we take Nigerian grades, if we compare Akpo and Aminam with Bonga plus EA or Forcado, or if we take in the Mediterranean two naphtha-rich crude, CPC blend and Saharan blend, their supply is almost stable because European refiners are shifting as they see that people are buying less and less diesel-driven cars and buying more and more gasoline-driven cars. As a result, there's more demand for gasoline in Europe, which is resulting in stable light distillate supply from West Africa and from Kazakhstan and Algeria, in spite of increasing U.S. flows. But this might shift if U.S. increases its supply to Europe too much. As far as heavy supply is concerned, heavy sweet supply to Europe, it remains relatively stable. I mean, it has never gone, only occasionally gone beyond 0.6%. I mean, heavy sweet supply. When the total crude slate, it jumped in November 2019, but otherwise it has remained more or less stable, 0.5, 0.6% of the total. As far as individual crudes are concerned, what we have seen is that Nigerian Agena grade has been at the top, especially when it started its production. Agena is the most, crude with the most supply in Europe. As far as heavy sweet is concerned, it has an API of around 27. I mean, we also see Sierra from the North Sea, also a big contributor to heavy sweet supply. But Europe has never been willing to pay $30 premium for heavy sweets. It has not been willing to pay as high premiums to dated Brent as Asia has. So as far as North Sea shipments are concerned, once South Korea used to be the key buyer of North Sea crudes as far as Asia is concerned, but now things are shifting. In 2019, South Korea didn't import too much. It was China taking over, and as you have probably seen, more and more crude from Norway, Johan Sverdrup, is going to China. And although we saw in the Middle East and also in the Asian market, China buying less, but according to the information available to us, February volumes of North Sea crude going to China are likely to be around the same level or even above that level compared to January. So as a result, China still buying. Probably they see that prices have come down. As a result, this is a good opportunity for them to buy Johan Sverdrup. Same is the case for Forties increasingly going to China. And as far as the Asia share of the North Sea market is concerned, it has remained around 15% since 2017, although players have changed. But at the end of 2019, we saw a big shift, so probably Asia's share is likely to increase to 17-18% of the North Sea market. As far as crude prices are concerned, Forties prices and also other key grades have often reacted to Asia's buying. There is a correlation between Asia buying crude and Forties prices, so probably it's likely to have an impact in 2020, and if China stops buying, it will have negative impact on the North Sea market. Now I will hand over to Alex, our refined product expert.
Thanks, Hassan. So I'd like to talk a little bit more about the kind of refined products market. I think that it's quite difficult to sort of understand the impact IMO 2020 has had on refined products in general. Generally, refiners have several options to produce VLSFO, so 0.5% gas oil to sort of conform to the IMO standards. But predominantly, it's made from feedstocks that are diverted away from secondary units, so quite difficult to track on a physical basis. So what I've done here in a lot of the slides is looked more at the sort of pricing indications as a way of trying to understand how some of these fundamentals have shifted and perhaps linking it a little bit to what Ehsan has said in terms of how that's affected the crude slate. So firstly, if we take sort of data from the Netherlands, we can look at refinery yields here to work out perhaps how things have been impacted. I think what's quite interesting here is we can see there was a sort of notable drop in production of diesel relative to refinery throughput in September. This is a little bit speculative, but we could perhaps suggest that some of this was refiners looking to divert some of their VGO away from secondary units towards the bunker pool. I think that generally the viewpoint from ARA is that there have been a lot of plans put in place to kind of meet this specification, and that really has reflected well in the pricing of what's going on here. So we sort of estimate that refiners have sort of increasingly opted to produce their VGO from sweet crudes using VDUs at the expense of diesel output. And so this is quite an interesting trend on the run-up. But overall, I think that most people would consider that VLSFO will be produced instead of gasoline from FCC units. So most of it's quite closely tied to the economics of FCC units. So VLSFO at the moment remains more profitable across our forward curve, but we think that as summer approaches, this spread will narrow quite considerably. I think there's been several times where looking at the forward curve on a margin basis, that gasoline has actually reached parity or perhaps even exceeded 0.5%. At the moment, there is still some profitability there in the bunker demand, but I think that's what's really going to be driving the economics. And considering that there's a bit of a tighter gasoline balance in Europe at the moment, it really is dependent on how much we see export demand from the US in particular, as to whether or not refiners are going to be sort of competing to use their feedstocks into FCC units, or whether they're going to divert them to the bunker pool. So really, on a margin basis, I think that what we've kind of understood here is VLSFO is far more tied to sort of clean product dynamics rather than high sulfur fuel oil in the past, which was really a crude and residual driven market. And that's kind of muddying the waters really in trying to understand how these sort of markets are shaping up. So as I said before, we'll perhaps look a little bit more on a pricing trend and also see how regional variations have also given us some indications as how refiners have reacted to this problem of producing 0.5% fuel oil. So if we look at, say, the pricing spreads at the moment, the spread between 3.5% HSFO and VLSFO have broadly sort of moved in line between Northwest Europe and Asia. We can see, unsurprisingly, the sort of spread has steadily declined in sort of lockstep with each other right down until the current sort of value at the moment. And that's really, broadly expected. We expected VLSFO to sort of get picked up. I think now at the moment, towards the last months of last year, sales volumes are sort of in the 50% to 70% mark for VLSFO at the expense of HSFO, and we've sort of seen spreads narrow right down to around about 150 tons in both regions. But I think perhaps what is more interesting is if we compare the sort of pricing differences in Rotterdam and Singapore for VLSFO versus diesel. I think that early on, a lot of people suspected that people would really favour MGO over HSFO when they were switching across, but the reality is that once stability issues and various other supply chain issues were resolved, VLSFO has really become the sort of major sort of bunker fuel of choice, really. But if we look at these sort of pricing spreads between the two regions, what you see here is that at several points post implementation in Singapore, VLSFO is actually more expensive than diesel on a per ton basis. That really was quite an interesting and surprising factor and had really sort of multiple reasons behind it, which I'll go into. But for the most part, I think that, although Singapore had a build-up of 0.5% components, which the market really anticipated a shortfall, I think that took a lot of people by surprise how unprepared they were for this upsurge in demand for that particular grade of bunker fuels. And so, although I think this trend is kind of reversing now, we're seeing you can see that from the pricing sort of movements that VLSFO is coming back down in price. Some of that is driven by reduced demand from the coronavirus, but for the most part, I think also supply chain issues have been resolved, and there are some sort of movements towards improving supply. But for what we can kind of see right now, it's still pricing quite expensive within Asia, and I think that for the near term at least is going to continue as a trend. So why is it more expensive, I think is a good question. I mean, if you look here at the bunker sales in Singapore, we can sort of see the scale of issue that was faced at the end of the year, with most buyers really leaving it till the last month or two to sort of make the switch, which was quite understandable given the pricing factors and the lack of impetus to switch over. So the latest figures from the Port Authority show that December VLSFO sales make up about 60% of total volumes, and HSFO is now around 20%. So most of the reasons behind this pricing pressure were temporary. I think domestic production is really still the main driving factor of why it's more expensive. Chinese output was constrained by some tax delays. I think that's been resolved, but they will take some time to ramp up their output sufficiently. I think they'll start getting tax rebates from the beginning of this month, but the news reports are that they'll take a few more months really to get everything in, sort of set up in several of the refineries to produce enough VLSFO to put out into the market. So that was one major issue, and I think for the foreseeable future, there's new units coming on that will hopefully kind of increase domestic supply in Asia. I think there's units coming in South Korea and Malaysia, for example, but they won't really come into effect until later on in the year. So I think domestic supply will remain an issue, at least for the foreseeable future, and keep prices of VLSFO above alternatives. Bunker barges was one issue. So we had, there were some sort of issues with barges that previously carried high sulfur fuel oil needing to be cleaned. There were some registration issues as well. But I think one of the bigger problems has been compatibility concerns. So because the VLSFO is made up of often several different components and different blends, compatibility means that some of the barges perhaps are reluctant, same with owners, reluctant to mix and match VLSFO blends. So that sort of tightens up the bunker pool. There's a bunker barge pool, and then when you sort of add into that there's been a lot of consolidation as well within the Singapore bunker barge market, that also again causes some of the supply constraints. So again, we think this is more of a temporary issue that probably will get resolved with over time, but this has caused that kind of price spike, and we're waiting for the sort of downward correction. And then lastly, I put this as a point in about MGO concerns. So, you could argue, well, if diesel or MGO is much cheaper, why not just buy that? And to be fair, we are seeing a bit of an increasing trend for people to start switching over to MGO, probably for these reasons. Some of the tightness in supply, and some people are seeing the benefit there. But I think for the most part, the issues have been the worries about lower viscosity of the fuels, meaning you have to add more components into MGO. I think also, we're really kind of seeing these long-haul tankers preferring VLSFO due to the density, which makes bunkering having to bunker less often. And so overall, I think we are seeing a slight shift in opinion towards MGO, but I think because VLSFO has been adopted quite strongly as the preferred bunker fuel of choice, I don't see any sort of major change in that going forward. But these are the reasons which are really giving quite a lot of support to Asian prices relative to those in Europe. So I think Northwest Europe has, as I said before, has really kind of positioned itself as a price leader for VLSFO. If we look at the different prices of bunker fuels in the different ports, we can kind of see how it really is kind of priced cheaper for both VLSFO and HSFO on a spot trend as well. So, I think that this is going to be a sort of a factor for the foreseeable future. I think a lot of this comes down to the adaptation of refiners to sort of meet the needs of the market within the ARA compared to other regions. Particularly because they're able to sort of direct their streams away from secondary units into the bunker pool if they need to. I think this is for the foreseeable future. Northwest Europe will be the sort of lower price factor, and I think they will have ample supply. So, if we look at, say, scrubber economics, this is something which I've updated with the latest information that we have in looking at the calendar spreads. It makes quite an interesting picture that I think a lot of people were sort of comparing the prices of VLSFO relative to distillate-based options. So when we actually look on a VLSFO versus HSFO, you can see that the payback period is actually perhaps a little bit longer than people anticipated, and has obviously started to increase as well as we've reduced the spread between the two prices. So the payback period I think is about 1/3 higher as of February compared to the beginning of the year. There's also some factors involved in terms of delays in scrubber installations, but for the most part, I think scrubber economics still generally make sense, particularly on larger vessels which have sort of larger fuel requirements, VLCCs, long haul tankers and routes. Overall, I think the payback at the moment we're looking at about a year and a half based on our estimates. So again, I think the scrubbers are still here to stay, and I think that that's also going to provide some support to HSFO. But I think going forward, we're quite surprised about the relative strength of HSFO, and that has been something which I've looked at as well as part of this. So these have been stronger than expected, and the reasons behind that really have been as a feedstock used within the US, which is quite surprising. So, some refineries who had large exposure to HSFO cut runs, which tightened supply and sort of propped up prices. But I think a lot of the supply actually headed over to the US. We saw a kind of ramp up of buying of Russian fuel oil, which would normally go into storage and then head out to the east, because prices had fallen sufficiently towards the end of the year that people were looking to sort of exit their positions. We can kind of see a situation, this has kind of trailed off now a little bit, but we've seen a situation where this has really propped up a little bit HSFO more than expected, because we sort of anticipated that demand would really drop down quite sharply, given that scrubber demand was considered to be marginal, anywhere between 10 to 20%. This use as an alternative feedstock for refiners in the US has given it sort of perhaps a bit of surprising support. So if we look at the the forward curve for 3.5% fuel oil in Rotterdam, you can kind of see the backwardation we have at the moment. And this really has been maintained across its IMO, and I think that has taken the market a little bit by surprise. I think generally people expected supplies to be diminished, tanks to be emptied. But we have seen this kind of unusual amount of strength in the 3.5% market. And if you look at the structure as well, we kind of anticipate, or I suppose the market kind of anticipates that demand will flatten out next year. And I think that broadly is because the market will sort of settle down, and I think it'll reach a sort of natural equilibrium where feedstock demand and scrubber demand, once we have these new units come online that have been delayed due to high freight rates at the end of last year, will really settle that market back down again. But this has been a surprising trend, which I think not a lot of people anticipated. I think not a lot of people realised that the sort of the blending demand in the Gulf Coast particularly would have kept these prices up. So I think that will provide a floor to those prices going forward. And then lastly, just want to sort of touch upon distillates. We really saw support fail to materialise for distillates towards the end of the year, and that's really there's a few reasons for that behind that. So we saw flows of diesel and gas oil into Europe really ramp up towards the end of the year. Some of that was down to sort of maintenance, in the autumn, and then some of that was because of what we mentioned before, some of the streams being diverted away perhaps. So there were sort of strong margins which really pushed a lot of distillates towards Europe from Russia and the east of Suez. So we saw quite a lot of flow arrive in January in particular. and that really has suppressed the margins. But again, it sort of plays into that factor of it's difficult to unpick the global picture along with bunkering, but we kind of see the distillate market at the moment pretty well supplied going forward, and that has put a little bit of pressure on the margins. So I mean, if we look at the margins at the moment for diesel in a lot of the major centres, you can see there's been a lot of pressure. This really contravenes what was expected for distillates. I think that the IMO trend was really expected to boost distillates, and I think actually the opposite has occurred. Again, you could perhaps imply that producers were expecting a shortfall in distillates, and that's why they produced so much of it towards the end of the year. And when it didn't materialise, and when that VLSFO shift happened, we were left with a little bit of a glut in most of the demand centres. Again, this is all slightly rebalancing now as we kind of come up to refinery maintenance. There's less supply coming through from the east. We've got maintenance coming up in Europe, so I expect that sort of supply-demand balance to readdress itself going forward. But yeah, again, this has been a bit of a mixed market. I think perhaps you wouldn't have expected such strength in high sulfur fuel oil and such weakness in diesel, say 6 months ago. So yeah, it's an interesting time for the product markets at the moment. So with that, I'll say thank you very much and pass you back to Rohan.
Great. Thank you very much, Ehsan and Alex. I think excellent insights and real deep understanding of different markets that we've heard. Now, as I mentioned at the beginning, we will take questions. So if you have questions, please feel free to type them in the Q&A bar, and we'll start tackling them one by one. We already have quite a few questions coming in, so I think let's tackle a few of them now. And then obviously as more come in, we will try and ensure that we can answer as many as possible. And again, as a reminder, if we run out of time, we will reach back on your questions individually, and we will provide an overview or an answer to your question. And also the webinar recording will come through anyway, so you guys will have the recording available. So Ehsan, I think let's start with your side of things first. We had a question about the impact of trade agreement between China and America in terms of crude oil. So do you have any thoughts and comments on that, if the trade agreement is creating an impact on the crude oil markets?
I mean, as far as I understand, China will be reducing tariffs on U.S. crude imports, I think starting February, which would mean that they might be buying more crude. They have also committed to buy certain goods with certain amount has been I think shown in the agreement. This would mean two things. First of all, because they will be buying light sweet crude, which is mostly naphtha-rich crude, it might result in then limited buying from suppliers such as Algeria or Kazakhstan, so which might have impact on these countries' crudes. But as far as West African market is concerned, most of the crudes from West Africa are distillate rich. It's likely to have a limited impact. As far as the North Sea market is concerned, most of the crudes going to China are similar to their own crude supply, which is Daqing or Shengli, and these crudes have an API of something similar to Johan Sverdrup 28, sulfur contents of around 0.8, 0.9%. So only crude which really competes against Johan Sverdrup is Lula from Brazil. So as a result, I don't think that more buying from the U.S. will have any impact on the North Sea market, but it might have some impact on the Mediterranean market with suppliers such as Algeria or Kazakhstan.
Great. Thank you very much. Quite a comprehensive answer, and I think it touched on some of the other questions we had as well around the U.S. and China increase in crude products and imports. Alex, probably a question for you on the demand side. How do you see the gasoline demand growth in Europe, strong or limited?
Yeah, I mean, that's quite a good question. I think we're coming from a relatively low base of inventories at the moment. So, but then conversely, I think US has got quite a high inventory. So, given that we're so tied to the sort of US as an export market and perhaps less so West Africa, I think that there is some upside here, and I think that given that VLSFO is going to be so competitive for feedstock into FCCs, you could argue that there is a lot of upside for gasoline over the summer, because in theory we should see those economics start to come into play. I guess it really hinges upon whether we think that the US market this summer is going to be strong. Indications are that it won't be, given where margins are right now, and given we've got such an issue with potentially in demand in Asia at the moment. I think the upsides are going to be limited, but I think given I struggle to see that we'll see such low margins as we've seen in the past, just purely because I think that there are more balls in play, so to speak, with this new bunker specification. I think that there will be a floor to the gains, but yeah, I'm struggling to see much upside right now for gasoline.
Great, thanks, Alex. And I think regarding VLSFO in Asia, we are seeing one or two questions come in, and I know you went through in detail on the slide about the reasons behind the pricing we're seeing in the Asian market as well. But would you expand on some comments on the Asian market overall, Alex? That is the supply a core issue? Is the pricing worthwhile? Is it the right way of pricing things? What's the overall kind of assessment, and a bit more expansion on the Asian market might help?
Yeah, I think it's I think we have quite a lot of reasonably good pricing, I think, on Icon for spot pricing, for margins for VLSFO in Asia. We spend a lot of time looking at that market. We have people in Singapore assessing that market. So I think our kind of outlook for pricing is fairly robust, but I agree that the pricing factors at the moment have been surprising given given the situation and demand, particularly at the moment. I think the market is in a process of rebalancing itself still. So I think there was a lot of, perhaps you could argue, panic buying early on when IMO came into effect, and that really pushed up prices beyond what people were largely expecting. And I think that situation, as I said, will kind of calm down and settle down. We're already seeing that really on the pricing side, and I think that's only going to improve if we see Chinese output increasing, which it should do, where we see these new units coming online in South Korea and Malaysia, as I mentioned. And I think pricing will rebalance itself, so it's not such a huge spread to distillate-based alternatives. So I'm kind of expecting the Asian market really to start sort of settling down, to sort of be more in norms with Europe and Fujairah and other regions. I think that will happen. I reckon probably more likely towards sort of middle half of this year.
Great, thanks, Alex. Ehsan, probably one more question for you regarding the recently announced sanctions against Rosneft trading. So the question goes is, how do you assess the impact of the new U.S. sanctions against Rosneft trading?
I think it will make it more difficult to bring Venezuelan crude to India. It will make more difficult to bring Venezuelan crude to Europe. As far as other crudes are concerned, as far as Russian crudes are concerned, I think the impact will be insignificant, but it could mean that the stoppage of Venezuelan crude supply to Europe, and India might have difficulty in receiving Venezuelan crude, because Rosneft has been operator of some of oil fields in Venezuela, and it is going to be very difficult for them to bring this oil then to India or some other destinations which were receiving this crude in the past.
Great, thank you very much, Alex. Probably something on the high sulfur fuel oil. What is HSFO used as a feedstock for the USA?
So I think most of the refiners it's predominantly in the Gulf Coast, were importing Russian fuel oil straight run to blend with lighter shale crudes. So the region has generally struggled really to sort of heavier up its crude slate to reduce its exposure to gasoline, particularly outside of the peak driving season. And with sanctions on Venezuela and Iran, places it's become increasingly difficult to find the right heavy crudes. And I think that it saw an opportunity to blend these Russian sort of residual products into their crude streams to effectively produce more middle distillates and less gasoline and light ends. So I think that's really what was driving that trend. And I think towards the end of the year, it really was a good opportunity to sort of offtake some of that production that couldn't be blended away or refined away in other means. But I think that trend has decreased. We've seen less of it going on just purely because of the strength of pricing for fuel oil, because I think people have shifted their refinery operations away to producing as much. I think that trend will continue, but perhaps on a sort of less brisk pace, should we say?
Can I add something to that? So we have seen even high sulfur fuel oil from Russia going to as far places as California. And I think what people are looking at, that high sulfur fuel oil should be significantly, it should be priced much lower than Mexican Maya in order to justify this float to the U.S. But some high sulfur fuel oil has gone to the Gulf Coast as well as to the West Coast at that time when high sulfur fuel oil prices was much lower. Because of the rise in high sulfur fuel oil, it's becoming more difficult, as Alex pointed out.
Great. Another one for you, probably, Hassan. It's about the current Brent spot prices. And the question goes by, are the current Brent spot prices a fair estimation of the average prices through 2020? $1 million question, probably.
It's very difficult. I mean, in the end, the fair price of a certain crude is normally how the market sees it. And I think as far as price for the whole year is concerned, it will also depend on how long the impact of the coronavirus outbreak loss. It will also depend on demand in the U.S. and which is very much dependent on the overall economy. Similarly, in Europe, there are certain factors such as Brexit, which might have impact on as far as the economy is concerned. But I mean, whether it's a fair price, it's normally the market which determines the price. Whether it's fair or not fair, it's something to be decided by the market.
That makes sense. Yeah. Good answer, I should say, in that regard. Alex, about the diesel margins, I think we have a question about the overall diesel margins. And it goes as, when do you think the diesel margins will recover their multi-year low levels?
Yeah, I mean, it's interesting. I suppose, as I said, we're kind of moving into seasonal maintenance in Europe, which, arguably typically tightens up margins, and we're seeing quite heavily reduced flows from the east of Suez markets at the moment. We had that big surge, and not so much now, again, because they're kind of going into turnarounds. You'd argue perhaps that with the reduced demand in Asia, we should see more flows filtering through to Europe, which could suppress margins. But at the moment, that hasn't really manifested itself. But on the flip side, Russia's been exporting sort of record levels of diesel in the last few months. And so they really filled in a lot of the demand aspects of that. So it is difficult to say. I mean, the margins, for the most part, if we consider that crude should be on the upswing, and storage economics at the moment don't really make much sense. The structure's pretty flat. It really is quite a challenging time for diesel. So yeah, I mean, I'm struggling to think that even if we go into a kind of heavy turnaround maintenance period in Europe, that there'll be sufficient tightening to really lift margins sufficiently back to where they were, say, a few months ago. So yeah, I mean, I can't say when, but I certainly would say not in the in the next month or two. I mean, I said the pricing curve shows that, but given the fundamentals, I don't really see a huge opportunity for diesel if we consider that Asia demand is pretty weak at the moment. That should, in anything, be more bearish for margins going forward.
Great, thank you. And probably we'll take just one or two more and give some time back to the people as well. Hassan, oil webinar, we can't get away without answering a question about OPEC, obviously. So a question has come in about how long, in your view, OPEC can sustain the production cuts. And I think a related question to that is that there's a meeting coming up in March 2020. So what's your view? Will it create an impact on the Brent oil rally, or the meeting will have some sort of a say on the cut supply as well?
I mean, a few days ago, I read an article in which somebody wrote that OPEC has become a permanent production cutter. So I think with U.S. production going up, it's becoming more and more difficult for OPEC, and I think at least for this year, they have to cut production by another 500, 600,000 barrels per day, depending on what the impact is of the coronavirus outbreak on demand. But I think OPEC is likely to, OPEC Plus is likely to reduce its supplies further in order to stabilize prices. But as I said before, it will depend on how low Chinese demand goes, because it's still not known whether China will recover from the coronavirus outbreak in 1 month or in 2 months from now. If it continues for a few months, then demand is likely to suffer more. But at present, people are looking at a demand destruction of around 200 to 350,000 barrels per day for this year.
Great. Thank you very much. Alex, another one for you. And again, I think it's probably more on the VLSFO side. The question goes, are VLSFO specifications becoming more uniform, so creating a more competitive market between suppliers?
Yeah, that's a good one. I think for the most part, there are some settling down of requirements for VLSFO. I think that as we go further forward in this process, I think some of the fears of compatibility will start to reduce. But from what I gather, most people are still reticent to mix and match VLSFO blends and suppliers. At the moment, I think it's still slightly untried and tested, just purely because blends can be done in such different ways. There's lots of paraffinic issues and from different blends that I don't see a situation where, again, at least in the near term, where we will see a huge amount of consolidation for the different grades. And I think that is posing a pricing problem as well, because availability within different bunkering ports of a shipper's preferred grade is going to still pose a problem. But I think there are a lot of movements towards unifying the different blends and making sure that there are compatibilities. And I haven't heard of any major problems, but I guess people are still erring on the side of caution right now. We're still very much early on, and of course, if blends are switched because of different refinery economics and change, and then we do find out subsequently there is a compatibility issue, then there's quite large ramifications for the bunkering market as a whole. So I think at the moment people are still erring on the side of caution, and that's probably giving a bit of a boost to the prices because of this reason, as I said, that people don't want to mix and match these blends. Barges tend to be carrying separate blends, again, don't want to mix and match. So until that's sort of all ironed out, I think we will see this slightly fractured market.
Great. Appreciate it, Hassan and Alex. I think, as I mentioned, we will tackle, there are a number of other questions as well. So what we will do is collate all the answers and distribute them to everyone on the webinar. A reminder again that the recording and the slides will be sent across over emails in the coming days, hopefully within a week or so. And everything you heard from our experts today, and also beyond that, there's a lot of research, analysis, data, fundamentals that is available via ICON and all the other products and tools that we offer. Obviously, beyond oil, natural gas, ags, hydro, carbon emissions, metals, and so many other teams, around 160, 200 odd analysts that we have in the commodities world for Refinitiv. They do provide daily updates via ICON. So if you are interested, and definitely if you would like to learn more or have a free trial of ICON, please do reach out to us. There will be a survey popping up at the end. You can identify your interest, and one of our specialists will reach out to you to ensure that we can provide all the in-depth analysis, data, and fundamentals to you at your fingertips. So with that, I appreciate everyone who dialed in. Thank you very much, Alex and Hassan, for sharing the great insights on the webinar today. We will have more webinars going forward. There will be a series of different asset classes that we will be tackling over the next coming months. So please do keep your ICON. If you are in ICON, you'll notice different banners popping up. Do indicate via our website if you would like to hear more and ensure that you are on our mailing lists, or if you are in touch with your CSMs, specialists, account managers, or Refinitiv contacts, please do identify that you would be keen to listen more on our insights via the webinars. So with that, appreciate all of you joining in, and hopefully see you all soon. Thank you and goodbye.